Hi, welcome back to the channel. Over the weekend, investors around the world have been asking one very simple question. What happens when a war-driven oil shock collides with a possible AI stock bubble? Because that's exactly where we are right now. On one side, the war in Iran continues to escalate, oil prices remain elevated, peace talks appear to be stuck, missiles are still being fired, and the risk of further disruption to global energy supplies remains very real. But on the other side of the equation, something completely different is happening. Elon Musk's SpaceX is preparing what could become the biggest IPO in history. Investors are desperate to get involved, and there are growing concerns that money is now flowing out of AI stocks and into SpaceX as investors scramble to raise cash. Now, that might not sound like a big deal, but on Friday, the Nasdaq fell by more than 4% in one day. AI stocks were hit the hardest, technology stocks sold off, and suddenly investors started asking whether this is simply a temporary wobble or the beginning of something much bigger. Could this be the first crack in the AI bubble? Could the war in Iran be about to trigger a much wider economic slowdown? And could Monday become one of the most important trading days of the year? Because if confidence starts to disappear, things can move very quickly. And that's what I want to talk about today. But before we get into the details, could I ask anybody that hasn't subscribed yet to please hit that subscribe button. Also give me a thumbs up for this video whilst you're there. It's just right next to it. Because it really helps me with the algorithm and also puts a smile on my face. And I also wanted to mention that my competition, where you come in my property or a cash alternative prize, closes this Friday, the 12th of June. So if you haven't bought a ticket yet, then now's the time to do so. Time is running out, and I'm offering some really exciting deals at the moment. You get lots of bonus tickets if you buy one. So if you'd like to get involved, scan the QR code on the screen now if you know how to do that, or click the link in the description below, which will take you through to the independent company that's hosting the competition on my behalf. So best of luck to everybody that's in the draw. Now, let's get back to what's happening. The story that has dominated global markets over the last few months is the war in Iran. And despite ongoing discussions about a possible settlement, there is still absolutely no sign of a breakthrough. In fact, if anything, the situation appears to be becoming more complicated and less likely to conclude. Over the last few days, there have been further missile and drone attacks across the Gulf region. Reports are indicating that Iranian forces launched several attacks towards Kuwait and Bahrain. USA and allied defense systems intercepted those missiles, but the United States then responded with further strikes against military and surveillance targets inside Iran. So despite all the diplomatic discussions taking place behind closed doors, the reality on the ground remains unchanged. The fighting is continuing, the risks remain elevated, and markets are becoming increasingly concerned that there is no resolution in sight. And that's important because the longer this conflict continues, the greater will be the impact on the global economy. Now, one of the key reasons that negotiations appear to have stalled is that there are several sticking points. The first is frozen assets. Iran wants billions of dollars of frozen funds released as part of any settlement. In terms of how much they have actually had frozen, it's anything between 12 and 24 billion, depending on which reports you've read. The United States, however, is considering a completely different approach. It's been reported that Donald Trump is having discussions about whether some of those assets could be used to compensate Gulf states for damage caused during this conflict. So you can immediately see the problem here. Iran wants its money back, but the United States is considering giving it away to somebody else. So those positions are not even close. They are miles apart. The second issue is uranium enrichment. Iran maintains that it has the right to continue enriching uranium for the use in power stations. The United States wants enriched material removed from the country and restrictions put in place because it believes that it's being used for nuclear weapon development. So again, there's no common ground here. The third issue relates to the wider regional conflict, particularly Lebanon and the role of Iranian-backed groups operating throughout the region. And the fourth issue centres around future security guarantees and the Strait of Hormuz itself. Who controls access? Who monitors shipping? How can Gulf nations be sure that future disruption won't occur? So none of these are minor issues. These are fundamental disagreements. And until they're resolved, the risk premium attached to oil prices is likely to remain. Now, here's the interesting part. Despite one of the largest supply disruptions in modern history, oil prices did not go up to $200 per barrel. Not yet. And a lot of people are asking why. And the answer to that appears to be China. Recent data shows that Chinese imports have fallen significantly. In effect, one of the world's largest buyers has stepped back from the market at precisely the moment when demand destruction was needed. It's reported that they've actually cut back by 40% compared with this time last year. And that reduction in buying has helped offset some of the supply shock. But it also creates a major risk because if China decides to increase its purchases again, perhaps to rebuild inventories or secure future supplies, then the balance changes immediately. Suddenly the market becomes much tighter. Prices could rise sharply, and if oil starts moving towards $150, $175, or even $200 per barrel, then inflation becomes an even bigger problem than it already is. And inflation is the next part of this story because on Friday we saw a very significant move in financial markets. The Nasdaq was down by more than 4%. The S&P suffered one of its worst sessions for a long time, and technology stocks came under intense pressure. AI shares were hit particularly hard. And that reason wasn't just Iran, it was down to inflation. The latest employment data from the United States came in significantly stronger than expected. The economy continues to create jobs. Consumer spending remains relatively resilient. And whilst that all sounds really positive for the USA, it creates a problem for the Federal Reserve because a stronger economy means inflationary pressures are less likely to disappear. When you combine that with elevated oil prices, rising transport costs, and ongoing geopolitical uncertainty, suddenly the possibility of higher interest rates starts coming back into the conversation. For months, markets have been expecting rates to go lower in the USA. Investors have been pricing in those cuts. But now some analysts are beginning to question whether rates could actually start rising. And that matters enormously for technology stocks, particularly AI stocks, because so much of their valuation is based on future earnings. Higher interest rates reduce the value of those future earnings today, and also higher interest rates may reduce demand and just calm the growth in the economy. And that's why the reaction was so severe. But there is another factor that may be contributing to the sell-off, and that factor is Elon Musk. SpaceX, which he owns, is reportedly preparing what could be one of the largest IPOs ever in history, potentially the biggest of all time. Demand for that IPO is enormous. Investors around the world want to get involved. And in order to buy new shares, many investors need to generate cash. Where does that cash come from? Well, in many cases, it comes from selling something that they already own. And that's led to growing speculation that investors are reducing positions in AI stocks and technology companies to free up liquidity ahead of the SpaceX launch. Now, whether that's the primary reason for the sell-off remains open to debate, but it certainly adds another layer of pressure to a market that was already looking vulnerable. And this brings us to what I think is probably the most important question of all. How does a stock market crash actually start? Because if you see a crash in a cartoon, you see a giant red button being pressed somewhere and suddenly prices collapse. But that's obviously not how it works. A crash usually begins with a trigger. Something causes investors to become nervous. In this case, the war in Iran, or maybe inflation, or maybe the threat of higher interest rates, or maybe the sell-off in AI stocks. Or it could simply be investors deciding that valuations have just become too high. But once confidence starts to wobble, investors begin selling. And here's the really important part here. Stock prices don't move because of what happened yesterday. They move because of what investors think is going to happen tomorrow. So if millions of investors spent the weekend worrying about oil prices, inflation, interest rates, and the movements in technology stocks, the market can open dramatically lower on Monday morning before many people have even had the chance to place a trade. The reason is that buyers and sellers are already lining up before the opening bell. If there are significantly more sellers than buyers, prices simply adjust lower until demand appears. So if you're sitting there thinking, I'll wait until Monday morning and see what happens, the market may already have moved before you get the opportunity to sell. Now that doesn't mean all of the selling is over. Far from it. Some of the largest market corrections in history have unfolded over days, weeks, and even months. What matters is what investors collectively decide next. Do they see Friday as a buying opportunity, a dip in the market, or do they see it as a warning sign? Because if enough people believe prices are going lower, they'll start selling. And when prices fall, more investors become nervous. And when more investors become nervous, more selling takes place. And that is how panic spreads. And once panic becomes the dominant narrative, things can move surprisingly quickly. Now, I'm not saying that we're about to see another 1987 style crash. Nobody knows. But what I am saying is that the risks today look very different from the risks that investors were discussing just a few weeks ago. A few weeks ago, the conversation was all about AI. How high could these stocks go? How quickly can earnings grow? How large is the opportunity? Today, the conversation is changing. Now, investors are asking whether valuations have gone too far, whether higher oil prices could reignite inflation, whether central banks may be forced to maintain tighter monetary policy or increase interest rates, and whether the war in Iran is creating risks that markets have not yet priced in. And that's why tomorrow matters, because markets don't move on facts alone, they move on confidence. And confidence can disappear much faster than it arrives. If markets stabilise, Friday may simply become another temporary scare. But if selling accelerates, then investors may be questioning assumptions that have underpinned the rally for the past few months. The assumption that inflation was under control, the assumption that interest rates were coming down, the assumption that AI valuations would continue rising forever, and the assumption that the war in Iran is only a temporary matter. These assumptions are now being challenged simultaneously, and that's why I believe we're entering one of the most important periods for financial markets this year. The war in Iran is ongoing, it's unresolved. Oil prices are very high and could go a lot higher. Inflation risks are definitely rising. Interest rate expectations are now shifting, and AI stocks are coming under pressure at the same time as one of the biggest IPOs in history is about to arrive. Individually, each of those issues definitely matters, but combined, they have the potential to create something much bigger. And that's why the title of this video is Panic Spreads, because what started as a geopolitical crisis is now beginning to ripple through financial markets, energy markets, businesses, consumers, and investors around the world. The question now is very simple. Does the panic stop here, or is this just the beginning? So hopefully you've enjoyed today's video, you found it useful, informative, and most importantly, thought-provoking. If you've liked what I've said, then please give me a thumbs up. Please subscribe to the channel if you haven't done so already.